Hi everyone, welcome to another Honeystocks.com stock market outlook video for the 24th of September 2022. Now, it has been a few weeks since our last social media video. A lot has happened with the markets over the course of the last 2 weeks, so of course there are a lot of charts and a lot of data that I would like to update. We've had another 75 basis points hike from the Fed, which of course, there's a lot of fatigue with, I think, a lot of the news headlines. There's a lot of headwinds for stocks in general at the moment, and the market has continued to crash after the recent bear market rally that we've seen. Now, we are pressing up against some very key technical levels, support levels in the market. I think we're at a very critical juncture. I think that's probably the first thing to say. And I think many of you are asking if there is any light at the end of the tunnel. So, like I said, I have a lot of charts that I want to get through this weekend. Many of the charts that I've actually shared with our clients this weekend as well. So I hope you get a lot of value from this weekend's analysis. And if you do get some value, please do like and subscribe on YouTube, and feel free to follow me on Twitter as well. In the bottom right hand corner of your screen, you should see a little subscribe button, which should be working now. Now, as most of you know, I do not use the magical hindsight indicator. I timestamp all of my work. Some of the big recent calls that I've made in the market: I called the bear market rally back in June. I called the crash at the start of the year. I called the recent top in August, and you can go all the way back to the 2020 crash as well. Now, before I get into the charts, please pause the video. Make sure you're comfortable with that very important disclaimer before watching any further. And enough about me, let's dive into some charts. So where I would like to start this weekend's analysis is with a broad overview of the market. Now, this is my watch list that I use on a daily basis just to get a gauge of what is going on, broadly speaking, with the market. Now, of course, I'm not going to get into a lot of the carnage that's under the surface and talk about past data, because as you all know, I don't use the magical hindsight indicator. But if we just, for example, just bring something up like the value line geometric index, which is the average stock in the market, we are pushing up against key levels, what I would consider to be key support resistance levels. So these are the types of charts that I'm watching very, very closely at the moment. We can drill it down to the individual sector performance. Of course, the last week has been an absolute annihilation for a lot of the areas of the market that have been performing very, very well year to date. We can look at natural gas, oil, exploration, energy, etc. Have all been beaten half to death this week. Commodities, they've not been safe either. If we bring up something like DBC, for example, again, we are showing signs of a lot of weakness there, and we are breaking below key support levels. So I think the reason I'm wanting to highlight is much of that just as a picture perfect look at the market. It just shows that there's a lot of carnage under the surface, and this is not an environment where you could be, in my opinion, aggressively long or short. Now, we can look at seasonality. Now, at the start of the month, I put out in my weekly letter just highlighting the dangers of September. Now, September traditionally is a very, very poor month for the S&P 500. Coming into every single September, I want to pay attention to the data, because at the end of September, it's traditionally the month end that creates a bit of a problem. Now, just to show that this is on average at the end of the month, we can see last year, for example, that the The S&P 500 on the 28th of September 2021 dropped 2%. So this is the kind of data that I drill it down to. Over the last 70 years, we can see the end of the month has historically been a big problem. Now, the problem, in my opinion, and I've been banging the drum on the dollar for the whole year. The dollar's been ripping while stocks have been going down. Now, pretty much every one of our European clients has been reaching out to me over the course of the last couple of weeks asking when is the US dollar going to stop going up, because there's many of us that are based in Europe that have converted everything into the US dollars and have done very well on that trade. But there has to be a point, and I think the point is coming sometime soon, where we can reasonably expect some kind of cooling off with the US dollar. Now, if the US dollar is going to cool off, what would that mean for stocks? Well, if we know it's been dollar up, stocks down for the last year, what happens if dollar down? What does that mean for stocks? So I'm looking at the market through that lens currently. I think we're reaching a level of overbought with the US dollar index that we've only seen 3 times previously: 1981, 1985 and 2015. I think we are at a level where we can reasonably expect some kind of cooling off with the US dollar. That said, I think the environment that we're currently in, if we look at the macroeconomic conditions, I think we are in uncharted territory. It would not surprise me in the slightest to see this make new highs with RSI and for ultimately the upside objective of $120 to be met within the next few weeks. So I have my eye on this chart. I would like to see the US dollar index cool off at these levels, but I wouldn't be surprised if it doesn't. But I think everybody needs to pay attention to the 200-week moving average in the major averages. I think we've got the previous history tells us 2011, we've got 2016, we've got 2018. We did dip below with the COVID crash. Now, I should say that I much preferred the COVID crash over the current crash that we're experiencing. This one is just a long, drawn-out, painful process. For me, 3,500 is a big level for the S&P 500. Historically, this has been a buy point. So what I would ultimately like to see here is these levels hold up. I'd like to see the dollar drop off. We can look at the S&P 500 on a daily time frame. Now, if you picked up my free weekly letter on Thursday, you'll likely know that this is a level where I've been anticipating some kind of rebound. So it is no surprise to me that on Friday we got, at the start of the day, we had a bit of a massacre to the downside, but as the day progressed, we started to see buyers step in at these levels, and that's ultimately what I would like to see happen. What I really like about the current levels that we are in the market, it gives us a very clear risk to reward proposition. So if you are in the camp that you would like to buy stocks, it's very easy to say when you shouldn't be buying stocks. So for me, what that looks like, if you are in the camp that the market has bottomed, then you can buy stocks. But if we start to break below these key levels, again, that's a big problem. And that's an environment where we're probably looking at words like capitulation, spikes in volatility, etc., etc. So ultimately, I would like to see these levels hold up as they have done historically. But if they don't hold up, it's very easy in that case to then step to the other side of the room. And of course, we're looking at, hedging strategies, puts, volatility, calls, etc., etc. So that's really the current framework that I'm looking at. But we are at these key levels with all of the major averages, and if they all go at once, please just have some kind of plan in place. We've got the Dow again pushing up against the 200-week moving average. And of course, it does look like, again, potentially primed to break to the downside. We have the Russell 2000 again flirting with the June lows. Now, just for disclosure, over the course of the last week to 10 days, I have been prepping our clients and members for this move to the downside, and ultimately a lot of the shorts and a lot of the hedging targets have ultimately been met this week. So for me, it's really a case of just watching, waiting, and waiting to see what happens next. We've got again the triple Qs. Big tech has never closed below that 200-week moving average. The last time it did it was at the financial crisis. We are pushing up against this level once again. So again, ultimately, just to reiterate, I would love to see these levels hold firm. Over the course of the last week, I have been looking at buying Google, but Google is showing a little bit of weakness at the moment as well. And despite it being Google, which we all know over time it's going to be fine, for me, I would much rather wait and see what happens with the broader market before jumping into any mega cap tech positions. I'd like to see some kind of bounce. I'm quite happy to pay a few dollars more for the stock, for the safety and the peace of mind that I can sleep at night knowing that the market has already rebounded from these levels. Now, what I would also say is, if you are still watching this, please do hit the like button. It tells me that you're getting a lot of value from this, and of course it's always appreciated as well. Now, let's get into the NYSE composite. The NYA composite has broken below the COVID crash levels. Now, for me, again, that's a problem. But ultimately, if we start to see the S&P 500, we start to see mega cap tech catch a bid early next week, then you would expect this chart to resolve itself and move higher again. But again, it's one of those charts that I think says to me that certainly be very, very cautious in the current environment. Like I said at the start, being aggressively long or aggressively short is really just opening yourself up to an absolute world of pain, especially when we get the inevitable counter trend rally. So I wouldn't be comfortable aggressively long or aggressively short. We've got the NASDAQ composite again. It looks a bit toppy to me. So if we start to break below the 10,000 level, for example, again, we're probably in an environment where we're seeing words like capitulation, and we've got a lot of the mainstream media nonsense as well. But whatever you do, please don't listen to Jim Cramer. I can't take any more. We've got the 10-year Treasury note yield breaking out of a big base again. That's another one of those headwinds for stocks. Again, been prepping our clients and members for this one over the course of the last 10 days, and ultimately it has broken out. I think this chart was actually I posted it to Twitter a week or so ago, and it was featured in the chart report, which I'd highly recommend everybody goes and signs up for. The best analysts, I promise, are not on StockTwits. They're hidden around Twitter, and I'd highly encourage you to go around Twitter in the financial Twitter community. Now, again, I get a lot of questions about the energy space. Of course, energy met our upside targets months ago, and ultimately it has fallen away. We're starting to see the carnage now translate into the individual names in the energy space. For example, I think ConocoPhillips was one of our recent high conviction ideas that was put out to members, which did very, very well. But on Friday, the thing got massacred, 10% overnight. That's the kind of environment that we're in. If we, try to forward look, what happens if oil starts to break down? How would that impact commodities? Well, I don't think that's bullish for commodities. And if you look at something like DBC, which I highlighted a short time ago, that seems to be quite an obvious short to the downside if there is conviction on a move to the downside in oil and energy. Of course, we've got financials, again, looking very, very toppy in the current environment. We've got the mid caps, again, pushing up against things like 200-week moving averages, and of course, getting primed to test the COVID crash levels. And of course, we've got volatility, which has been absolutely ripping over the course of the last week, along with credit spreads. So, if you're in the camp that the market is trying to find a bottom here, and we're looking for buy positions in the market, which I should say I currently am. I'm tentatively just looking around, but I want to see some kind of confirmation from price that tells me that the market is going to rebound, even if it's only in the short term. I'm quite happy with a week, 10-day bear market rally. That's the environment that we're in at the moment. So if you're in the camp that these levels in the broader market will hold, again, you'd probably want to see volatility start to tail off here. Again, for those of you that like crypto, big level for Ethereum. Again, I've been highlighting this one to our clients over the last couple of weeks. Levels look to be holding up at the moment. And of course, the Bitcoin chart, again, probably hasn't changed for the last few months. So really, that's the analysis for everybody. If you are somebody that has been struggling majorly in the current environment, feel free to stick around for a minute or two. But please do, as I said before, hit that like button. Feel free to subscribe to our channel. We try to upload once every couple of weeks, depending on how busy I am, of course. But if you have just stumbled across our work, feel free to jump on to Honeystocks.com. We provide professional charting research to all of our clients and members, financial advisors, and we provide premium weekend analysis every single weekend. We provide a midweek halftime report, which is a bite-sized version of our weekend analysis. We provide high conviction ideas, provide access to a community on our platform, which I should say is a very professional platform. It's not WhatsApp groups or anything like that. I've got a very professional platform on Workplace. Provide access to our chart books and also provide access to our complete technical analysis program for those of you that are looking to perhaps learn a bit more about technical analysis. But ultimately, I think most of our clients and members know what they're doing, and hopefully if you are considering our services, then hopefully you do know what you're doing as well. But just to show you what our ideas look like, this is a recent idea that went out for ConocoPhillips. Again, I did touch on ConocoPhillips in the analysis. Again, this is a high conviction alert that went out at $100. We've got access to charts like Netflix, again, one of our high conviction alerts. It's found resistance at $250, but again, it's been a good little winner. The steel index was a good winner. We've got the commodity index, which was a great short earlier in the year. Zillow was a great short. Box was a terrific short. But I'm very, very unique. I timestamp all of my work. Every single high conviction alert that's ever went out to our clients and members is logged on our website for complete transparency. So feel free to go and check all those out. We do not recommend things like penny stocks or any of that nonsense. It's all high quality names. The bias, of course, over the last few years has been to the long side, but there are opportunities to the short side as well. But I think we're probably a good fit if you are maybe too busy to hunt around social media. Maybe you want to be part of a community, and maybe you're looking to get away from day trading because the pennies dropped, that it's just not consistent. But if you've got a mid-term approach, we're probably a good fit. But feel free to do all your own due diligence on our website. But if you're still here, don't forget to hit the like button, and thank you very, very much for watching. Thanks.